All right, everyone. Welcome back to another episode of Forward Marginal Guidance, which is, of course, the name of Jack and my mix-up collab show here. Today, we are joined by Michael Howell of Cross Border Capital. Michael, welcome back to the show.
Great to be here. Thanks for the invitation.
Great to be here, Mike. Great to talk to you, Michael, again.
Good. Hi, Jack.
Absolutely. So maybe we can just dive in. We're recording this just a couple of minutes after Chair Powell's FOMC address has ended. There was a lot to unpack there. Before getting into kind of the nitty-gritty details, Michael, I'd love to kind of just turn it over to you and kind of get your high-level take on Chair Powell's address.
Yeah, I'd say after having listened to a lot of these FOMC press conferences, I mean, this has actually been one of the most interesting ones that I can remember. As you say, there's a lot to unpack. I think that Chair Powell was very transparent. He answered a lot of the questions very honestly, or as honestly as he could have done. So I think that he gave a lot of clues about the way the FOMC sees the path forward in a way.
So could you maybe get into some of the details there, Michael? Like what stood out to you, and maybe just to give the audience like the subtext, at least for me, going into this FOMC meeting and why there was so much attention on it is, the Fed had been up until this point very clear about the desire to hike and to use Powell's exact words to get the job done. Right. But, just a couple of these past 2 weeks have been marked by several high profile bank failures and actually culminating in a bank failure over in Europe in the form of Credit Suisse. So there was kind of a bit of questioning about how much leeway the Federal Reserve really had to keep hiking rates. So I guess what, with that subcontext in mind, I mean, what kind of stood out to you from this FOMC?
Well, I think one of the things that seems to come out is that we're a lot nearer the peak in rates this week than we were last week or 10 days ago. I think we're coming near to that summit for sure. There may be debate about how quickly rates can come down, but I think it was interesting in the sense that let me pick out a couple of points that I noted. One was that Chair Powell noted there'd been a sharp tightening in U.S. credit conditions as a result of these bank difficulties or failures. So I think that's one point to note. That clearly will have to be taken into account in future assessments of monetary policy. The second thing is that the FOMC's own estimates of the terminal rate, which I think one would have inferred may have gone up a tad pre the meeting, was actually left unchanged. So it's sort of signaling that we are, in my view, somewhere near the peak in rates. That's at least as they see it. The other thing I think that comes out of this is really about the balance sheet. And I was kind of surprised by maybe the transparency and maybe the honesty with which Chair Powell addressed a lot of the very pointed questions about is this QT, is an expansion on the balance sheet essentially derailing the existing policy? What does it mean, etc. And I think there was a lot of insight that came out of that. And, the takeaway that I would say is that he said, look, this is not an attempt to alter monetary policy. In other words, this temporary lending to the banks. It's very different from the prior policy of large-scale asset purchases, which was actually the accumulation of treasuries that got put onto the Fed balance sheet during the COVID crisis. He sees this as being different. It's not an attempt to ease monetary policy, but what I would say is it probably results in an easing of monetary policy. And that may be a subtle difference, but my reading of this is clearly a QT, a quantitative easing, or as I put it when I was, tweeting the other day, it's a quantitative something, and we got to hope it's a quantitative easing, and that's what I would say. Now, if we cut to the sort of the chase of this, the question that everyone's really got to ask is this: is why are the banks the major casualties of increasing interest rates, not borrowers? Because if you look at what the economists say or what the textbooks tell us, it should be the borrowers that are getting squeezed by higher rates, not the banks. So something odd is going on here. And rather like 2008 and rather like 2012 in Europe or 2019 or again in 2020, what this tells us is that it's a funding or liquidity crisis. And that's really the key point to take away. So in other words, it's not borrowers that are being squeezed so much or the real evidence of blood on the streets. It's actually the banks. And the banks are clearly in a situation. Now, I think if we take this narrative and we kind of roll forward, what does it mean? I think that the state of the banking industry worldwide is sufficiently troubled that what we're moving to quite quickly is a de facto nationalization, if you like, of the world banking industry. Now, that's a big statement, but let me try and unpack that a little bit. The first thing is that when SVB needs to be bailed out, if my memory serves me correctly, the FDIC initially said that large deposit holders would not be fully bailed out. In other words, there'd be the $350,000 US limit. Correct? Right.
Mm-hmm.
Mhm.
In 2012, after the European banking debacle, then when you saw many banks under great pressure, I believe there was an agreement among the G20 governments that no banks would be bailed out or depositors would not be made good apart from these limits. Okay, so the FDIC and the G20 had agreed there would be effectively no bail-in of depositors. And what do you get? The Treasury or the government essentially derailed that and said, SVB, everybody, all depositors, whatever they've got, are made good. So this is a fundamental change. And as far as I can see, and actually Chair Powell, to his credit, sort of hesitated about actually confirming this. He, said he wouldn't comment anymore, if my memory serves me correctly. Essentially, what this means is de facto, in my view, that bank deposits have been more or less guaranteed. Now, if the US is doing this, and clearly we don't know, this is my inference, we don't know it's true, but I think that's the extrapolation one's got to make here, then all other governments worldwide have got to make the same commitment, because otherwise the US banking system, which is underwritten by the Treasury, is going to look a lot better than the European or the British or the Japanese or whatever it may be. So I think that this is essentially saying what you've got is we're moving towards a situation whereby the balance sheet of commercial banks and the balance sheets of the central banks are de facto merging together. So effectively overnight, we've virtually nationalized global banks, and we're moving very quickly towards central bank digital currencies, or that effect. And that's a big statement. So that's my view of what's going on. The US banking system is clearly fine under that backdrop. There's no problem, okay, at all. But the issue that you've got to face is that what's going on now and what the problems, where all these problems were exposed, is that the funding structure, to come back to my point, this is not, this is a funding crisis. The funding structure of banks worldwide is actually very difficult. They with a lot of losses on bonds, and after all, we saw that back in 2008. The losses were different kind of losses. They're about credit risk. These are about duration risk. But those losses basically need to be made good somehow. And what you've got is the monetary authority now standing behind that. So I think that's an important point. The second thing I would go on to say is that the corollary of all that is that banks under this particular situation have probably got to be much better regulated. In other words, you've got to expect sometime down the road a Basel IV, if you like. In other words, they're going to have to, there's got to be more oversight on what banks are doing. And that may mean at the end of the day, they hold more government debt. Now, that may be, if you like, a virtue from the government's point of view. And what you've got is a situation where this may be deemed financial dominance. So in other words, the banks have been, they've been bailed out and they've got liquidity. But at the end of the day, they are then being, if you like, subservient to the governments, because the governments will use that balance sheet to actually hold more and more government debt. And that, if you like, squares a very important circle. But it tells us one thing, if I'm correct, that we're looking at a situation moving forward over the next few years where structurally the level of inflation in the world economy, or at least in the West, is going to be higher than we've been thinking. And the reason for that is that there's an awful lot of debt to finance out there. In other words, government debt. Just look at the CBO figures that have recently been released for the next decade about US fiscal spending and the size of the deficit. They don't even put in what is likely to be a significant step up in defense spending. I've said as well in many occasions that the US is actually the cleanest shirt in the laundry here once you start looking at other countries. So the US is not that bad relative to what's going on in Europe, for example. And so what you've got is a lot of debt to sell, and the banks may be the recipients of that. So effectively, the growth of debt by the US government is going to be reflected in the growth of bank balance sheets, which is going to be reflected in the growth of money supply, which, as we know, is ultimately determining the long run inflation in the economy. So I think there's a lot to unpack in that, but that's my view of what's going on. And what we're likely to see coming out of this crisis is a significant increase, in my view, in the size of the Federal Reserve balance sheet. We can dance on the head of a pin and say, is this QE or is this not QE? My view is it is QE. The multiplier effect onto the economy may be disrupted in the near term, for sure, but ultimately, this is going to have an impact.
Right. And there's so much to get into, Michael. So there's the solvency of the banking system, and then there's liquidity. Solvency are the assets exceed the liabilities. You have more than what you owe, and the liquidity is the ability to finance those assets. So the Federal Reserve's discount window, as well as the bank term funding program, where it's extending credit, lending banks cash against collateral, which actually can be posted at par value at a premium to what they would trade at the market. That's supplying an ample amount of liquidity. And a lot of that, as well as the discount window, is responsible for the pickup in the Fed's balance sheet, which is followed by many. But then there's the level of solvency, which is affected by the level of rates, because as interest rates go up, banks which have a lot of duration risk, the value of those would go down, and their funding costs might increase as well. Is this primarily a liquidity issue in the banking system, or do you think it's a solvency issue? And dependent on what your answer is, does that impact your view of what the Fed ultimately will do?
Yes, I think the answer is yes to most of your questions. I think the first thing is, yes, it is a liquidity problem. That's for sure. That's why I've said it's the banks that are really getting hit here, not really the borrowers. And that's telling you it's about funding and liquidity, and there's a problem. There could well be ultimately a solvency problem, because at the end of the day, if you look at the bank term funding program that the Fed's put in place, it's effectively meaning that banks that take up this facility are borrowing at 1-year rates. And those rates are now a tad higher after the rate increase today. But they're basically they're getting as income. They're paying out 1-year rates plus 10 bips, but they're actually getting in as income the coupon yield on their existing securities. Now that is below the level of 1-year rates, probably significantly. So the Federal Reserve is actually embedding now an operating loss in these banks on their security portfolios. And that comes back to the yield curve being inverted. Now, what you can't have over the long term is an inverted yield curve. So effectively, you've got to have that changing its gradient. And if we're in a situation, as I suggested, where there is more oversight and more involvement in the banking system, both in the US and worldwide, then I think you're looking at a situation where we move very quickly to what I've called yield curve control. Now, yield curve control, as we know, has got, there's a yield curve control in Japan right now. You could argue that there's a form of yield curve control in Europe in terms of trying to control spreads between different sovereign European debts. There was a long history of US yield curve control during World War II and immediately afterwards. All those episodes, I would say, have actually been pretty successful. And I think it's coming back again. Now, if you think about, to go back to the scenario that I outlined, is if we're in a situation where there's an awful lot of government debt to be sold in the future, and we know the banks are probably going to be on the hook for taking a large part of that, what's the interest rate that the government can stand, maximum interest rate? Now, I would suggest that that is somewhere like, and I'm willing to debate this, maybe 5%. You can't have anything more than about 5%. Otherwise, you get a big spiraling out in the interest bill for the US or for any other sovereign government worldwide.
Right, and Michael, just sets the stage. The Federal Reserve today just raised interest rates from 4.75% to 5%. So that's 5% your threshold, and we're there.
Yeah, okay, but we're there on the policy end.
Right.
So I'm talking here about long-term debt. So I think it's very difficult over the medium term or long term to get the interest rate on longer term debt up much above 5%, because the interest bill would be too high. Now, if you then said that the banks have got to earn a spread, and let's say you need a yield curve of, say, 100 basis points, then you're talking about a ceiling on the policy rate of about 4%, 4 percentage points. So in other words, we're above that level now. Now, if that's the case, that is effectively a yield curve controlled process if they want to maintain that. And if you run through the maths, and it may be sort of difficult right here on air to run through the maths, but very generally, if you look at the growth rate of federal debt, it's got to be mathematically equal to something like the primary budget deficit plus the interest rate, prevailing interest rate on the debt. Now, let me just try and go through these numbers just very briefly and simply. So if you've got a primary budget deficit of 3% and you assume that, let's say the debt GDP ratio in the US is 100%, which is near as damn it is, and you've got an interest rate on your existing debt of 5%, that's basically telling you that 3 plus 5 equals 8. So your debt is growing at 8%. That's what money supply will grow at if you've got the banks effectively monetizing that. And if you said the economy is growing at 2, your underlying inflation rate is 8 minus 2 is 6%. So that's what we're looking at as a very, very different world out here. And this is what I'm trying to say. If this is all correct, this analysis is correct, that this is going on, and what we're looking at is the early stages of this particular path, then assets like cryptocurrencies and gold need to have a step higher valuation jump. Because
you got Mike's attention.
Well, actually, I agree with you, Michael. I agree with a lot of what you're saying, and I want to get into the nitty gritty of sort of what you were talking about in terms of nationalizing the banking sector, because that's been sort of suggesting there's a lot of kind of strong pushback that that's not actually what's happening. So I want to dig in there. But before we go, super deep in the weeds, I do want to get your thoughts on a couple of things just as it relates to the FOMC. I'd love to kind of parse out your reaction to the market reaction to what Chair Powell said. And let me caveat this by saying that usually, very, very often, the initial market reaction to things like the FOMC is wrong. But what you had was it's a little bit confusing to me. You had the NASDAQ and Bitcoin both down. You also had the 2-year down. So the two questions that I have for you is, one, it appears there's a discrepancy in between what Chair Powell is telling the market, is what he's telling us interest rates going to do versus what the market actually believes. And basically, starting over the past couple of weeks, the 2-year has been a one-way track down because my guess is that the market has anticipated that Chair Powell has basically hit the liquidity floor, right? Or he's reached the amount of what he can do in terms of rate hikes. He says he keeps telling us that there could potentially be more. So I'd love to get your opinion on that. And then if you could talk to us a little bit about the market reaction to the FOMC.
Okay, I think the first thing is, how much more can rates go up? I think that we're, as I said right at the beginning, I think we're a lot nearer the peak than we were last week or 10 days ago. And I think that's the impression that one gets out of the statement. That doesn't say anything about the duration by which rates are going to remain at high levels. And it's long been my argument is that the problem that central banks have given us, which is zero interest rates or very low interest rates for a long time, created a problem of a huge debt pile. And the world economy is saddled with this big debt pile. And that's the problem we've got. We've got to get rid of this debt. So if you have too low interest rates, that is an incentive for debt. Okay, taking on more debt. You can't go back to that world of very low interest rates. And I think all these central bankers understand that point. The problem is, though, if you keep interest rates, you keep jacking up interest rates, you then create funding problems in the system. So, you're really walking a knife edge. And this is the difficulty they've got. So in my view, what you've got to go back to is a policy that was originally foreshadowed more than a century ago, a century and a half ago in Britain by somebody called Walter Bagehot, who was a financial journalist, but he's the sort of doyen of central bankers. Jim Grant in the US, well-known banking analyst, has written a wonderful biography of Walter Bagehot. And what Walter Bagehot's point was that what central banks have got to do, and this was in the early days of the Bank of England acting as the central bank or lender of the last resort, is he said what you've got to do is to lend freely, lots of liquidity in other words, against good collateral at a high interest rate. And the central banks for the last decade have been doing the absolute reverse of that. Now, what we've got to get back to is a sensible world. And I think what that means is that rates probably have to stay up at high levels for longer, but there's got to be more liquidity in the system to try and underpin the funding structure. And what we've got is a fragile funding structure. And the reason we've got a fragile funding structure is that basically because of all this debt, world financial markets have shifted from being new financing vehicles where you finance new capital spending to being primarily refinancing vehicles or rolling over existing debt. Now, let me just give you some figures to back that up. Okay. If you look at the amount of debt that's out there, it's about $350 trillion. Okay. With an average 5-year maturity, what you're looking at is probably 70 trillion a year that needs to be rolled over. If you're going to roll over debt, you need balance sheet capacity to do that. Balance sheet capacity is liquidity. So liquidity is absolutely paramount in this equation. Think of that 70 trillion against how much money is raised as new capital every year in world capital markets, which is 10 trillion. So you're 7-to-1 in terms of the ratio of refinancing to new financing. That's not what the textbooks tell you. And what that says, in that world, the flow of liquidity is far, far more important than the level of interest rates. Think of it as a homeowner. If you want to refinance your home mortgage, okay, you're slightly less concerned about the interest rate and really concerned about whether you're going to get the roll or not. Because if you don't get the roll, you're homeless. And the same with a corporate. If you can't refinance your debt, you're default. And that's really the issue. It focuses the mind. And that's why liquidity is so important. Now, I think that if you go back pre-2008, policymakers didn't get that point. I think what they're doing is they're getting that very quickly. And if you look at the alacrity with which the federal authorities moved to support SVB and other US banks that were in trouble, it shows that they're very, very conscious about this. And Chair Powell, I think, made it clear that although there were no discussions about the balance sheet runoff of treasuries, that's an open question. If it needs to be addressed, they'll address it. So I think the Fed is there in a way that we were maybe unsure about whether the Fed was there in mid-2008. Look at the speed with which the Fed opened up dollar swap lines to Europe and, in fact, the world last weekend. I mean, this is a bold move. Central bankers are clearly concerned about funding, and I think they're much more, up with events now than they were at previous times.
Right, and you can see that on the Fed's balance sheet. Michael, you track liquidity, many aspects to liquidity. One of them is central bank liquidity, and the Fed very prominent. We can see if people zoom in and they put their screen very close to their face, at the very right edge of that screen, you have a tick up in the Federal Reserve's balance sheet. It exploded higher during 2020. 2020 and 2021, it gradually drifted higher. Quantitative tightening enacted last year, a very gradual, slow decline. Not as big of a decline as people thought because of mortgage-backed securities. They weren't selling, they were extending in duration. That's a whole nother point. But that little blip up, is this an injection of liquidity? Fed Chair Jay Powell, Michael, today said people can rely on us to supply ample liquidity. Is it the discount window? Is it the bank term funding program? Is this quantitative easing? Is that not even a good point? How much bigger do you think this balance sheet will get, and why is it significant?
Well, I think if you work through the maths, it could work out to be a sizable jump. It could be, in theory, in extremis, 50% higher. Okay, and the reason I get to that figure is that if you look at the division between, let's say, smaller banks in the US and the bigger banks, start with the smaller banks. They've got effectively about $1 trillion of eligible securities that they can post to the Fed in this bank term funding program. Okay, so if the Federal Reserve supports them through that mechanism, even disregarding the discount window borrowing, that would actually increase the left-hand side, the asset side of the Fed balance sheet by close to $1 trillion. Okay, and that would immediately come through in presumably bank reserves. Now, it may well be that process involves a migration of deposits out of the small banks towards the big banks. Okay, but then you've got to ask the question that if you've got such a disparity between the rates, the deposit rates that large US banks offer compared with what you can get in a money market fund, why should you be holding money in a large bank? Why shouldn't you migrate to a money market fund? And if you migrate to a money market fund, then the banks lose reserves. and the big banks lose reserves. So if they lose deposits, of course, as well. Now, if they had to post this collateral to the Fed term lending program, funding program, they've got probably about 4 trillion of eligible securities that they could post. So what you could be talking about here is something like somewhere between 4 and 5 trillion increase in the asset side of the Fed balance sheet. Now, I won't get to that point. I'm talking about an extremist. But what I'm trying to show you here is the elasticity of the system. Now, the problem is that what we're talking about here is liquidity in the money markets. And if you look at the key number to look at on the Fed balance sheet is really the reserves of the banks, the reserves the banks hold at the Federal Reserve. And that is an indication of the amount of money in the money markets. Now, the reverse repo, which is another element on the balance sheet, is actually a withdrawal of liquidity from the markets. Okay, the Fed is basically holding that money on its balance sheet. Now, many people say, and I think it's an ill-informed comment, that the RRP, the reverse repo program, is indicating there's abundant liquidity in the system. It's not telling you anything about the abundance of liquidity. It's telling you about the generosity of the Federal Reserve in offering such high interest rates on its instruments, on its reverse repo instruments. That's why it's there. It's actually money that's being withdrawn from the system. And you could get a situation whereby the smaller banks lose deposits to the big banks and the big banks lose deposits to the money market funds. And in that situation, what you've got is a tightening of liquidity conditions in the US system. And the Federal Reserve would probably have to act on that to get bank reserves up. Now, one of the things that I think we've learned in the last 10 days is what is the minimum operating level for reserves. Okay. Now, our view at Cross Border was that level was about $2.7 trillion. Okay. Prior to this crisis, the Fed was operating bank reserves at about 3 trillion. Okay. And in fact, since the British gilt crisis in September of last year, that reserve number on the Fed balance sheet has flatlined at 3 trillion. And I think the Federal Reserve was trying to tell us something then, that the British gilt crisis was a warning, a little bit like Bear Stearns in the spring of 2008. That was the warning. That was the warning bell that said, we've got funding problems. There are funding problems here in the system. Okay. Somehow the plumbing isn't working properly. And what the Federal Reserve has engineered, in my view, and I think it's deliberate, but who knows, that bank reserve number flatlined at 3 trillion. Now, US academics who are experts on looking at bank funding, Jonathan Wright at Johns Hopkins being one in particular, have already cited a level of 2.5 trillion for the minimum operating level, reserve operating level for US banks. So we were getting pretty close to these thresholds, okay? And I think what we learned with SVB and others is that it's not 2.5 or 2.7, it's probably 3, okay? The problem is that once you get a crisis, the demand for reserves goes up. So in actual fact, that's 3 rising. And the level of reserves in the system now is a short 3.5 trillion. So I would suspect that's got to go up anyway. So I think what you're looking at here is potentially a significant increase in the size of the Fed balance sheet. And as I say, we can dance on the head of a pin and say, is this QE or not? In my view, it's a liquidity easing, and that's what the system wants. Okay. Whether it has a big multiplier effect on the economy is a completely different question. But the Federal Reserve has backstopped the system, which is what it's doing, and it's done it, I think, very effectively.
I've got a question for you, Michael. So, you were talking about the banking system sort of starting to nationalize in a sense. I do want to say, I think Yellen, despite some comments from yesterday, she actually said that they're not considering coming in and guaranteeing all bank deposits. So there is some limit in terms of what they're willing to do. But there's a great quote from Chris Cole from Artemis Capital, which has always stuck with me, which is, you can't destroy risk, you can only transform it. So, I think the majority perception, right, when the FDIC and the government rides in, is they say we are taking care of a whole bunch of risk that's in the market. Whereas I kind of generally try to ask, okay, there was a bunch of risk here that existed in the banking system. How is it being transformed? So if the federal government, some mix of like the government and the FDIC are guaranteeing larger and larger parts of the banking system. My question to you is, what's the transformation of risk that's going on?
Well, I think it's a very interesting point that you make, Michael. I think that the first thing to say is that there are obviously different types of risk that we've got to try and evaluate. And if you look at the problems that the banking system essentially has, we're talking about credit risk and we're talking about maturity risk or duration risk. Okay. Now, 2008 was very much about credit risk. This crisis is a lot more about duration risk. Now, the Federal Reserve can effectively resolve both. And the more that the Federal Reserve balance sheet expands, and that encourages, if you like, an expansion of the general private sector balance sheet, what they're doing is they're effectively reducing credit risk and duration risk in the system. Okay. And that's what the Federal Reserve can do. But to take up your analogy of the balloon, you're squeezing that balloon, you're reducing credit risk and duration risk. But what you're doing is introducing another risk, which may be inflation risk. And that's the problem. That what we know is that money the money that the Federal Reserve creates can seep out. It goes into asset markets pretty quickly, okay, because it's part of the financial sector. But that can seep again into the real economy and create high street inflation. The Federal Reserve creates monetary inflation or monetary deflation. Those are the only choices that a central bank really has, okay? But if you look at high street inflation is a cocktail of monetary inflation and cost inflation. So we've had the cost inflation because of what was happening with Putin's Russia and the COVID crisis, and that gave us some cost inflation. But we also had a dose of monetary inflation on top because of the growth in the Fed balance sheet. What I'm saying is, if you look forward, parche what may happen to costs in the future, but we may be getting significant and permanent growth of monetary inflation, and that's coming through not because of this problem per se, but because basically you've got very bad fiscal arithmetic in the West per se. And I come back to the fact, look, America is the cleanest shirt in the laundry here for sure, but it's still got problems. The rest of the world, big problems. It's all about aging demographics and the fact that you've got mandatory spending, which is shooting up, where your tax base, which is working population, is under downward pressure. That's still very overtaxed, and they can't get revenue up. And then you've got the added problem of increased defense spending, which is coming through. So how do you square the circle? It's really difficult. And you need, if you like, the banks to play a role in this. Now, maybe by some accident of history, we've just stumbled on the solution.
So if for the bank's balance sheet to continue going up, for banks to draw upon the bank term funding program or the discount window, that scenario that you envisioned would be one in which banks continue to have a liquidity crisis. It's not just Silicon Valley Bank, it's not Signature Bank. First Republic has to go down and take others with it. And in that environment, deposit flight ensues, and regional banks have to pledge their agency government securities as collateral to get money from the Federal Reserve. What do you think are the odds of that? The lightning doesn't strike twice or three times, and people just keep their money in the regional banks, and everything is fine in that world. And I want to know what do you think the odds of that? Does the Federal Reserve's balance sheet still go up? Do we still have is liquidity from the central bank still on the way?
Yeah, I think absolutely. I think that, in my view, I mean, we track liquidity pretty closely, as you know, and, I've gone on record and said many times since that the low in global liquidity was basically October last year. That was the floor. It's picking up. Bad things happen. We know bad things happen at the low point of the liquidity cycle. And hey, presto, what we've got again is another example of that happening. Banks don't go bust, or very rarely at the peak of liquidity cycles. They tend to go bust at the bottom of liquidity cycles. And that's, if you like, the instrumental factor that causes the cycle to turn around. So I think that now what central banks have got to start to do is to expand their balance sheets. Mm-hmm. And that's what I see happening worldwide. So this is what we're doing. Let's, for a moment, step across the pond to what's happening in Europe. The European Central Bank plans to shrink its balance sheet this year, on my estimates, by between 15 and 20%. Well, good luck with that. I don't think they're going to be anywhere near doing that because the state of the banking system in Europe is, certainly I would suggest more fragile than maybe in the US. But hey, prove me wrong. That's a risk. So I think what you've got to do is the important central banks in the world are really the US Fed and the People's Bank of China. Those are the ones that really matter. The ECB, the Bank of England, the Bank of Japan will come on and follow what the Fed is doing, as far as I can see. But those are the two independent voices. And what you're seeing is, on my estimates, the Federal Reserve is beginning to add liquidity to the system now. It's actually, if you look at the detail, it's following almost exactly the same path that it followed through 2001, 2002, in terms of its liquidity injections into markets. We're around the trough and it's beginning to pick up. And as I say, I think it's going further. And then if you look at what's happening in China, the People's Bank of China, through December and January of this year, injected about 3 trillion yuan, so a short half a trillion US dollars, into Chinese financial markets. That was a huge liquidity impulse. It represented 3.5 times the total amount they had put in the previous 2 years. Admittedly, it came off a little bit in February, but what they've been doing latterly through March is injecting a lot more liquidity in the system. And the PBOC in China is very, very important for the health of the Chinese economy, or the tempo of the Chinese economy. And hence, by definition, because China is such an elephant in the room economically, for the world economy overall. And China is restarting or attempting to restart on this estimation. So you've got that. And then the US is really the paramount central bank, which influences financial markets worldwide. So these two are really beginning, as far as I can see, to turn the money taps on. Now, if that's the case, what you want is to increasingly think about monetary hedges, or what I call monetary hedges, which are basically securities or instruments that hedge against monetary inflation. The obvious one to that is gold, because gold has been long-standing as a monetary inflation hedge. And I make this subtle but very important distinction between a monetary inflation hedge and a high street inflation hedge. Gold is not always a great high street inflation hedge, but it's a very good monetary inflation hedge. And the new monetary inflation hedge are things like Bitcoin. Now, it's not a recommendation to buy Bitcoin or anything like that. I'm not a Bitcoin analyst, but all I'm saying is these are likely to be pretty decent measures of liquidity. So if liquidity goes up, that's what you've got to expect to see as a barometer of that move: gold going up and Bitcoin going up.
So Michael, I'm in agreement with the vast majority of what you just outlined there. I suppose just again to kind of bring it to some of the events that have been happening today. I'm looking at the price of Bitcoin on my screen here, and it's basically been in free fall post FOMC. I mean, it's down about 4.5 some odd percent. So my question to you is, do you think the market believes the same thing that you believe, in terms of we've seen the liquidity bottom already basically this last October? We're already starting to see, overt injections over with the PBOC in China, more covert injections here in the United States, and that it's going to be liquidity positive from here.
Well, I don't think the market agrees with that, because the market's the market, and the market has many different opinions. But there may be some people in the market that believe it, and there's an awful lot of people that probably don't believe it. But our remit and what we do is we look closely at liquidity. Ever since the days when I was at Salomon Brothers in the US, I mean, this is what I learned at the feet of people like Henry Kaufman. Henry Kaufman, a gentleman now aged 95, but tremendous wisdom. I mean, go back and read some of the things that Henry used to write. I mean, he has nailed this current crisis yet again. Even in his writings of 20 years ago, he foresaw the future and these problems in funding markets. So I think you've got to understand that Salomon was a fantastic brand name and franchise, but it really made its name and its reputation and its profitability from understanding money flows in the world. And that's exactly what we're trying to do now. And so tracking liquidity, understanding where the money is absolutely fundamental to investment. And that's what people have got to do more and more. Central banks are increasingly playing a big role in that. So we need to understand what the central banks are doing. But it's not always the central banks that are the key drivers. It can also be the banking system, as we saw prior to 2008.
Right. And I just want to note that, Mike, you're correct. Bitcoin, gold, stocks, all falling in the wake of the Federal Reserve meeting today. But gold and Bitcoin and even stocks had been rallying over the past few weeks. And Bitcoin had gone from about $20,000 a month ago to $28,000. So what's that, a 40% rally. So if liquidity, the price action recently does fit that narrative of liquidity is supporting liquidity sensitive assets. Michael, I just want to ask you, when the central bank is supplying liquidity, there's quantitative easing when it expands its balance sheet, and that is, our balance sheet is going to go up no matter what, no matter whatever the banks think, whatever people think, our balance sheet's going up. We don't care. And then there are special facilities such as the discount window, now the bank's new bank term funding program, BTFP, where the money's here if you want it, but we're only going to expand our balance sheet if you want it. So if the banks don't need it, the balance sheet doesn't go up. And the reason we had a pickup in that chart is banks tapped the discount window and BTFP for funds. So how do you expect the Fed's balance sheet to increase in absence of those programs that rely on banks needing capital and needing
let me answer that question. In terms of how we see the world and how we operate, liquidity is a driving factor. And one of the most important transmissions for liquidity is in the term structure of interest rates. If you see liquidity expanding, the yield curve, in other words, the term structure, will steepen. The yield curve will begin to be upward sloping, and you'll get a steeper and steeper yield curve as liquidity goes in. As liquidity comes out, you start to see a flattening and inverting yield curve. And there's about a 6-month lead time between movements on liquidity and what happens in the yield curve. Now, what we've seen in the world is tightening liquidity. Bank funding has dried up. But fundamentally, where you're seeing this is through the negative effects of an inverted yield curve. This is what's giving the banks a lot of trouble, for the simple reason that, as we know, to give the example of the bank term funding program, if you go to this Fed window, you are going to have to pay the Fed 1% rates, and you're only going to get a coupon return from your security portfolio of probably maybe 50 to 100 basis points below that. So in other words, you've got an operating loss. So this is the situation that you're in. You can't correct the funding problems in the banking system until you got an upward sloping yield curve. And that's really a fundamental point. Now, why haven't you had maybe these problems historically when you go back? Probably because the banking system wasn't as leveraged. Maybe the funding structure was better than it is now. But the inverted yield curve is exposing a lot of these funding problems. And we do have a funding problem in the world where you can see, and I'm going to get wonkish here, but if you look at the term structure, there's an element in the term structure that economists or financial analysts will know, which is called the term premium. Now, the term premium you can watch every day because the New York Fed publishes estimates of the term premium on the US 10-year bond and other tenors. But if you look at that data, it is near its all-time lows. Now, why is the term premium so low and in many cases negative at the moment? And that's saying there's a shortage of collateral in the system. And that is one of the problems which is exposed in this whole funding structure. Now, what we're in is a world where credit is very dependent on collateral. In other words, pre-2008, banks lent to each other on trust. Now what they need is collateral. You need the security of an instrument like a government bond, or think of a mortgage. You need a house to borrow against, etc. You need an asset to, if you like, secure that loan. And in that world of collateral, what's really important is how much you can margin your collateral, because that determines how much credit you can get. Now, one of the key factors to watch, and these are the two things that I would watch very closely going forward, what you've got to look at is the volatility in the bond market. If you get high volatility, it's very difficult to get to basically use that collateral efficiently, because the haircut you'll get on the collateral go up. In other words, the lenders will start to say, well, okay, we're very uncertain about what the value is, so we're going to give you a big haircut on that collateral. And whereas you could have borrowed 98%, you're going to now borrow 90% or 85% or whatever the amount is. So that has a direct effect on credit. Now, my point here is that it may well be that the Federal Reserve injects liquidity. It may improve collateral. There may be more treasury issuance. But if you've got a lot of volatility in the bond markets, you are not going to get liquidity creation. And one of the things that the authorities have got to do is to get bond volatility down pretty quickly. Now, the MOVE index is one way to watch that. The MOVE index is published by Bank of America Merrill Lynch. It's an indicator that they put forward. It is a comparable indicator of the VIX for equities, but it's much more important than the VIX. Don't worry about looking at the VIX anymore. It's secondary. Look at the MOVE index, because the MOVE index is driving the system. And that's what people have got to start to watch. Now, the MOVE index, when it was first designed, if I remember correctly, when it went above, it's an index which roughly runs between about 50 and maybe 150. People used to say if it goes above 150, it tells you that the authorities, the Treasury or the Fed, have lost control of the bond market. What did it go to a few days ago? 200. What is it today? I believe it's about 160. So it's coming down, but it needs to go well below 150 and probably below 100. So bond volatility has got to come down. So watch the MOVE index. And the other thing is watch the reverse repo, which is a daily number that you can look at, the volume of reverse repos that the Federal Reserve basically has on its balance sheet. And if that starts to spike higher, then it's probably telling you that liquidity is draining out of the banking system. It's going to the money market funds.
Right. So money market funds used to own a bunch of commercial paper. Now, I think over half of that is directly parked at the Federal Reserve at the reverse repo facility. The point you said earlier, Michael, was that when people say there's $2.2 trillion in the reverse repo, liquidity is ample. I see why they say that, because it's $2.2 trillion. That's a lot of money, but it's trapped there, and people are putting all the money sort of in a black box that cannot really interact with the rest of the financial system. Also, volatility you referenced, that's how much things moved. There's realized volatility, how much things actually move in the past, and then there's implied volatility. What is the market pricing for forward volatility? VIX is implied volatility for equities. MOVE is that for bonds. When interest rates were at zero last year and Fed Powell raised, the market was caught totally off guard. So the MOVE index spiked higher, but corresponding with that sort of October pivot or policy that you've tracked, the MOVE index went down, and that coincided with a pretty significant rally in a lot of risk assets. And now the MOVE is back up, or it was up, because we had this banking crisis. So the hikes that were priced out for the rest of the year have turned into cuts. So you had an immense reversal that was very dramatic. But do you see now that sort of, okay, maybe we'll do a 25 basis point in May, but we're not, let's be honest, we're not getting to 7%, probably not getting to 6%, maybe 5.25%, but I think things are pretty clear now. Do you think that in that environment where there's a lot more certainty, the MOVE index could actually come down? And
it should.
Yeah.
Yes, it should come down. That's one of the things to watch. And I think what the authorities have got to do is to make sure that index does come down, because that's the key to, if you like, leverage. And if you put it another way, the collateral multiplier in the system. If the MOVE index comes down, the collateral multiplier will go up, and therefore you're going to get more liquidity created by the private sector. So if you think about it in two moving parts, the government sector in terms of bond issuance and in terms of the Federal Reserve balance sheet is determining the amount of collateral in the system, but the private sector is determining the size of the collateral multiplier, and that is driven to a very large extent by factors like the MOVE index, how much volatility there is in the system.
All right, that makes sense. Mike, maybe it's time to open it up to questions in a little bit, but I also just want to ask about the degree to which the turmoil in the banking sector will cause banks to contract credit and curb their lending, which would be very disinflationary, perhaps deflationary, perhaps recessionary. Jay Powell actually said as much, and he referenced that fact. It's the base case of the Federal Reserve that the turmoil in the banking sector will cause banks to curb lending somewhat. And he said that that may be equivalent of tightening of a rate hike, which is pretty remarkable. In fact, it could be even more of a rate hike. How significant of a factor do you think that is, and what are you seeing in the bank lending markets right now with regards to liquidity?
Okay, I think the first thing to say is it was a very significant statement. He actually said that there'll be a sharp tightening, or expected a sharp tightening of credit conditions as a result. He also said that these financial condition indexes that are very public now, there's a Bloomberg number, there's a Chicago Fed number, there's a Goldman Sachs number of financial conditions. He said were biased because they were largely equity of volatility measures, they didn't include many metrics on lending. And it was his fear that lending conditions had tightened. Now, we look at lending conditions pretty closely. And what I would say is that maybe this is a takeaway. It's very clear that you've had a fall in, or a tightening in credit conditions in terms of the appetite of loan officers to make loans. And that's very true in the latest surveys. However, and this is the caveat, that lending survey correlates really very closely with business confidence. So if you start to see business confidence in the US bottoming and beginning to pick up, and I'm thinking here of something like the ISM index, what you will see is pari passu with that, you will see loan officers getting a lot more optimistic. So I'm not going to say it's a given that we've got, we're staring down a black hole. We're not. In my view, I think the economy is actually pretty robust in the US, and all the indications that we have would suggest that the economy is probably seeing a bottom. I'm getting this information from the fixed income markets. Looking at the entrails of the fixed income markets, it looks like a bottom in the economy is coming about mid-year. Now, we may be wrong on that. We maybe have to finesse that a tad, but I would say that's what it's looking like. If that is correct, then the stock market is more or less on track, because the stock market normally bottoms about 6 months before the turn in the economy. So that looks right. Let me say one other point about that. Stanley Druckenmiller, the renowned US investor, always used to say that the best economist is the inside of the stock market. And what he meant by that, or what he was talking about, was the relative performance of cyclical stocks against defensive stocks. And if you plot an index, and don't take my word for it, please do it yourselves, look at an index of S&P cyclicals, less S&P defensives against the tempo of the economy. It almost goes one for one. But the stock market is the relative is a fantastic indicator of what the economy is doing. And what you're still looking at, even despite the volatility of the last week, is it still looks that cyclicals are outperforming defensives.
Except for banks.
Yeah, well, maybe except for banks, but I wouldn't necessarily say the banks are in that cyclical category. But hey, we can debate.
I've got just one more question for Michael before we turn it over to audience questions, Jack. There was one question which was asked of Jerome Powell. He made a comment apparently during the January FOMC, I believe, about some potential worries in the non-bank lenders. And my question to you is: there's an enormous amount of focus on solvency around banks. Probably rightly so, right? But banks, there's an enormous amount of demand for funding outside of strictly banks, right? Which this is like broadly referred to as the shadow banking sector, right? And a lot of the interest rate risk, right, that banks have taken, I would have to imagine these shadow banks, they basically have a very similar problem. The thing is, it's a much more opaque sort of market. The forcing function isn't depositors leaving, it's capital calls, right? And it's more risky and less regulated. So my question to you is, and they don't have this access to this BTFP facility. So my question to you is, are we being a little bit too myopic here about focusing on any one particular bank failure? And maybe we're missing the forest for the trees when there's a problem in this kind of shadow banking, less regulated, extender of credit.
I think you've nailed it. I think it's spot on. And I think that the way that the Federal Reserve initially addressed the SVB problem was to say it was an idiosyncratic problem. And that's pretty much what Chair Powell was saying. This is an outlier, but the solution they put in is actually a general solution for lots of things. And the shadow banks clearly don't get addressed in this directly, but what the shadow banks will depend upon are things like the stability of collateral in the system. And that's part of the reason why I'm saying you've got to get volatility down particularly in the treasury market, because that's where a lot of the lending will come on the back of security portfolios. Now, we don't know the underlying health of the shadow banking system. There's been phenomenal work done in the US about what the shadow banking industry is and its needs and its risks and whatever, but there are still black holes, okay? And that's the problem. So if you're shaking the money tree, you can get accidents. And this is the problem that we face. There may be another one around the corner we don't know, but this is the peril that you run at very low levels of liquidity. So this is why I come back to the fact that, it's low liquidity is the problem right now. You've got to get more liquidity into the system. But if you want to control the system longer term, it goes back to the Bagehot rule. What you've got to do is to lend at high interest rates against good collateral, but you lend freely. You create a lot of liquidity. And the problem that we've had is in a world where you've got capital markets, which are being used as a refinancing mechanism for debt, you can't also use those capital markets as the axe to try and control inflation. It doesn't work because basically your needs for refinancing may coincide, with periods when inflation is high, and you basically are squeezing just at the wrong time. And that's very different from a world of new financing, when in actual fact you're squeezing at a time when capital investment is down and probably you want it to go down further. So in other words, the world is topsy-turvy under this refinancing mechanism. And that's why liquidity is absolutely critical to watch.
Excellent. That's a very helpful explanation, Michael. And now I want to take this chance to answer any questions from the audience. And guys, if you're listening, thanks for all these comments that you're dropping here. But definitely, if you have questions for Michael, make sure to drop them, and we'll get through as many as we can in the time that we have. So this first question for you actually comes for this is on the topic of banks hedging interest rate risks. So SVB was criticized pretty heavily for not hedging, but how could the banks have this? The question is basically, how could they have hedged while being profitable? And the thing that I would append and add to that is the accounting treatment, right, of hold to maturity of a lot of these assets basically made it so that these bonds didn't hit the P&L or the capital account. So a hedge, if they had actually put that on, the way the accounting treatment works in the US, is the hedge would have actually appeared on the P&L and made the bank's profits look all wonky, right? So, is this criticism, both from a profitability and a P&L appearance standpoint, is this a fair criticism of SVB and for the banking sector writ large?
Well, I think it's the result of with the thing that we go back to, which is an inverted yield curve. And this is the problem they run into, because during a period of an inverted yield curve, banking becomes less profitable. And so, you either, fess up to that and report it, but then your shareholders won't like that, or you find ways of essentially disguising that. And at the end of the day, that's really what we're talking about here. So the question is that, normally in a world in terms of how the economy and the financial system works, you can't run an inverted yield curve for very long because it creates problems. And it almost automatically, it basically moves to a positive slope. And that's what we're looking at. Rates have to come down. And this is maybe the sort of the lesson out of this whole thing, is that what we're really saying here is that this is an unsustainable situation where short-term rates are above long-term rates. You've got to get the yield curve to a more positive slope. And that's why I come back to this point that we have to be moving into a world of yield curve control. I don't think there's any choice in that. And that's the reality, not least because the fiscal authorities have got so much debt they've got to shovel at us in the next few years.
Michael, when you say yield curve control, when I first heard that term, I thought it referred exclusively to pinning rates at, let's say, 2%, and the bond market wants to sell off to 3%. So price down, yields up, but we're keeping it 2%. We're going to buy it if it ever goes to 2.01%. But I subsequently learned that in Japan, it was actually to keep rates below a certain level, because they wanted an upward
Ceiling,
yield
yeah,
curve.
ceiling.
Yeah. So in this yield curve that you envision, is it to, let's say, keep the 10-year pinned at 3% because the 10-year wants to go to 5%, or keeping it 3% because the 10-year wants to go to 1%? And when I say want to, I mean, market forces.
Well, I think that the yield curve control is a generic term, and it can mean many different things. And as I said, what Japan is doing right now is very different from what the US did in the 1940s and early 50s, and it's very different from what the Europeans are doing. But basically, they're all different flavors of yield curve control. And what I'm saying is that yield curve control fundamentally here, the first thing you must do, first condition, is you must get an upward sloping yield curve. And that's something that needs to be addressed. Now, one of the problems with that statement is that if you've got such a negative term premium, this is a wonkish bond point, but it's very important to if people think about it. If you've got a negative term premium, it's very difficult to get an upward sloping yield curve. Okay, technically, so you need to get that addressed, and I think that's a question of collateral, lack of collateral in the system. Now, that may be addressed ultimately because there's a lot more fiscal issuance coming, and the Federal Reserve may have to put more liquidity in the system. But that's the first point. You need an upward sloping yield curve, and maybe the banks need 100 basis points of spread between the long end and the short end. But we can debate what that is. The second criteria is that you can't have interest rates at the long end so high that it starts to inflate the budget deficit significantly and create too much debt. Because basically the interest bill is eating a large part of the deficit right now, and every percentage point, on the interest bill magnifies that debt burden. So you've got to keep the interest bill lower. So what that says is that if that magic number is 5% for bond yields at the long end, say the 10-year tenor, and you want 100 basis points of yield curve slope to benefit the banks, then what you've got to have is a 4% policy rate at the front end. Okay. And that's how the maths will work. There's a variety of ways of getting there, but I think what you've got to do is to have the Federal Reserve and the Treasury working in tandem together. I think they do work together, but officially they are separate.
And so do you think that, let's say the 10-year Treasury notes will go higher or lower from here, given what you just said?
Well, my view for this year, if that's what you're asking, is that I think this year I would say the 10-year bond is a wash, because I think that we may be near the peak in the implied terminal policy rate that's embedded within the term structure. Arguably it may be there, it may come down a tad from where we are, but I think the problem you've got is that term premium, which is so negative, can almost only go up from here. Now, what you've seen, if my memory serves me correctly, since the SVB crisis, you've had terminal policy rates dropping by about 70 basis points, and you've had term premium rising by 35 basis points. So you've actually had the 10-year down effectively by about 30 or 40 basis points, or there or thereabouts. Okay, but the problem is that the more that you get policy rates down, implied policy rates in the term structure down, the more you're likely to get term premium going up again. So I don't think you're going to get much gain really from owning longer dated treasuries this year. If you want to play the treasury market, it makes much more sense to look at the sort of a mid-duration area, maybe the 5-year or something like that, but not to go too far out down not to take on too much duration risk right now. I don't think it will work. Traditionally, this stage of the cycle gives you moderate bond returns, not great bond returns. If you look at where you get most gain in fixed income at this current state of the cycle, it's normally in the credit markets. Interestingly enough.
Say that last part again. Sorry.
Well, the where you get most gain at this stage of the cycle, go back and look at 2001. Where you get most gain or traction in the fixed income markets is out of credits.
But wouldn't defaults be increasing because the economy is slowing down? Correct.
Well, that's the supposition, but then maybe you can pick and choose within the credit structure, and you can find opportunities. And I'm not a credit analyst or a bond credit analyst, but all I would say is that maybe the markets are telling us something in terms of what you're seeing. And if you look at how the fixed income markets are unfolding, this is a very normal cycle. Okay, you got to remember that the yield curve is inverted, but it's beginning, I think, to inch towards a steepening. You've got convexity, which has collapsed in the curve, which is the size of the hump in the curve. So that's come right down. You're looking at bond volatility, which is peaking and coming down. And you're looking at credit spreads, which are beginning to come in. And all those things are what you would normally see at this stage of the cycle.
So I just want to address the point of interest rate risk. So there's credit risk, there's interest rate risk. You lose money as interest rates rise because you are getting paid back, but it's just not being paid back enough. So a lot of banks, they made a mortgage at 3%, or more likely, maybe they bought a mortgage-backed security where they're being paid 3%. And that was all great when interest rates were at 0, but now they're at 5%. And the equivalent mortgage rate would be 6%, 7%. So 3% it really is not cutting it. But then do you say, oh, but the banks, don't worry about it because the banks can hedge out their interest rate risk. Yeah. And yes, I could hedge my interest rate risk, but I hedge it with you, Michael, and then you hedge it with Mike, and Mike hedges it with someone else, and the interest rate risk is there. The Federal Reserve is imposing losses on the financial system. So we've got a great question. We can just put it on screen about from CarPro. I've never understood the idea of hedging interest rate risk individually. That may work, but someone has to be on the other side. So the whole banking system cannot hedge their risk with whom? What do you say, Michael?
Well, I think that's probably right. I mean, at the end of the day, what you're doing when you're hedging is you're effectively selling that risk onto somebody else. So, but there are people that will bear that risk, and it may be that you've got longer term institutions that basically want to take on that risk. That's quite possible. But what we're saying here is that the fundamental problem that the US banking sector has got, it comes back to the fact that the yield curve is inverted right now. They didn't do the interest rate hedging anyway, but the question is right. I mean, all you're doing is really passing the parcel in many ways, in terms of somebody that must be taking that risk on the other side. But it may well be a long-term institution. It may be a sovereign wealth fund who's prepared to bear that.
We got another question from Harold Gray, who says, beware the steepener, as they say. So last year, the yield curve inverted, people saying it's going to be, apocalypse, so worried, but the economy was actually, pretty fine because it was early on. It's when the yield curve steepens, when short-term rates start falling, that is when, as Harold rightly says, you should beware because we're entering a recession. So you think the central banks, a huge influx of liquidity, and you think the economy will reach a nadir somewhere in the middle of this year, but isn't an inverted yield curve that starts re-steepening, isn't that kind of ringing the alarm bells from the market? Purely talking about the economy, not the financial markets.
And sorry, just one observation to add to that as well, which I think is in tandem, Jack, is this the 2-year and the Fed funds rate, which typically walk kind of hand in hand. The 2-year has now dipped well below where Fed funds is, which is usually the first signal that the Fed is starting to think about turning, or the market is sniffing out that the Fed is going to turn, which typically happens right when the recession is just become consensus, which also sort of supports that idea of steepening.
That's a great context. Thanks.
I think that's absolutely right. I mean, the question is spot on. Is that what normally happens at this stage is you see the short end of the market falling away, rate expectations tend to drop, and the longer end doesn't really move that much. So that gives you the steepening of the curve. Now, the problem that you've got this time, this particular cycle, is that term premia are very negative. And I keep saying this is a wonkish point, but it is true that it's not all about rate expectations right now. There's a big bias in the curve because of term premia. And that means that I think that the yield curve is not necessarily a pure indicator of recession risk right now. I think it's very biased. I think it's over-egging it, to my view. Now, I wrote a paper, which is an academic paper, but it was probably about 5 or 6 years ago, well, there or thereabouts, which is in the Journal of Fixed Income, that basically looked at the efficacy of the yield curve as a predictor of recession in the US. And actually, it's an incredibly flaky predictor. In terms of any particular maturity spread. So if you looked at the 210, it works sometimes and doesn't work others. If you looked at the 1-3, it works sometimes and not others. Looked at the 10-5, sometimes it works, sometimes it doesn't. So you can always find a yield curve that will actually predict a recession, but you never know which one it is. And the point, therefore, is that what's really important is looking at the curvature of the term structure, convexity. And basically, if you adjust, this is again sort of probably bond and wonkish stuff, but if you adjust the yield curve slope for convexity, which is what we do internally at Cross Border Capital, that gives you a much, much better predictor of the economy. And that indicator is basically saying that it should turn around the middle of this year or thereabouts.
There we go. Another person asked about the Federal Home Loan Bank and why that has exploded. And I think banks are just posting their mortgages there for cash. And I actually don't think they post mortgage-backed securities as the question implied. I think that's more discount window and BTFP. I know we're getting very wonkish, and I feel like Michael, you are so in the weeds and brilliant, and I feel like maybe I could have done a better job of sort of breaking down things for our audience. But yeah, I want to ask you just about the mortgage question, which is that mortgages are not only duration sensitive, but they have negative convexity, meaning that their interest rate risk rises as rates go up. So things get worse and worse, and the rate at which you lose more money itself increases, so which can be quite scary. But so banks have a lot of that on their balance sheets. The Federal Reserve also has a lot of that on their balance sheets. Also, the U.S. homeowner who borrowed money to refinance at 3%, the loss of the banking system and the Federal Reserve unrealized is the realized gain of the American homeowner. I know I threw a lot at you. Where does that lead us?
Well, I mean, if you're saying that, I'm not sure I understand the question, but are you saying that has the American homeowner benefited from low interest rates?
Yes.
And I think the answer, if that's your question, the answer is very clearly yes. The issue that you face in Europe is that you don't have fixed rate long-term mortgages. You basically have floating rate. And so the problem is when interest rates go up in Britain or in Europe, you start to get the housing market absolutely tanking. So if you look at the US and compare that with Europe, in Europe you haven't seen nothing yet. I mean, this can be a real mess.
Michael, I want to get back to something. There's a question here about CBDCs, and I want to tie that to something that you were saying. You mentioned CBDCs earlier. You also mentioned the nationalization of banking systems, both in the United States and Europe. I want to get I was actually having a conversation with a mutual friend of ours earlier today. I actually sent him your tweet that you sent either yesterday, I believe yesterday or earlier today, about the nationalization. Can you just describe what you mean when you're saying that? And then, the question that we actually have here from Bubbly Bull is feels to me like the central bankers are in need to sacrifice the private bank system in order to roll out their CBDC and get overall power on the economy. Thoughts? So my two-part question to you is, can you describe what you were saying before about nationalization of the banking system? And then does that factor into your thoughts, or what is the through line between that development and the development of a central bank digital currency?
Okay, well, let me just be absolutely clear here. What I said was that a de facto nationalization of the banking system. And it's not a nationalization of the asset side, it's of the liability side. So effectively what you've got is that the central bank and the bank's balance sheets are de facto merged effectively. So in other words, that if there is a deposit run, the Federal Reserve is stepping in to basically backstop that. Now, we don't know whether that's true, but what I've said is that's the implication of what Janet Yellen and possibly Chair Powell hinted at today, that's where we're on the US. I mean, time will tell. But I think that they've made certain noises to that effect, that the deposits or the deposit base of the US banking system is sacrosanct. Now, the question is, when push comes to shove, what does that really mean? Well, it means that the Federal Reserve balance sheet is effectively backing the banking system. So the balance sheets are effectively one. Now, isn't that what a central bank digital currency really is? So, in other words, if you've got a dollar in a bank, in JP Morgan or whatever, that's really a digital dollar in the Federal Reserve. I mean, it's for all intents and purposes the same thing. And that's really what central bank digital currencies were doing. So essentially, you've got a digital dollar. It may be administered by a US bank, but in other words, the funding structure is much more robust under this situation than it has been before. And you won't get a deposit run because there's really nowhere else for the money to go. The central bank is the central bank. And I think that's the way to kind of think about it. There's nothing sort of sinister in that per se. A dollar is still as good as a dollar. But the fact is that it does give the policymakers greater say, if you like, in the structure of assets. Now, the central bank is never going to be a lender in the way of lending to different businesses. It can't get into that game. It's a political game. So I'll have to get the private sector to actually organize credit distribution. That will continue in that form. So what you may have is some hybrid whereby the banks act maybe as sort of, I don't know what you would call, or what we call in Europe, gyro banks. So they're basically depositories of money, and they maybe administer accounts. And then if you want to create credit, then they will invest in dedicated credit managers who may be specialists in different industries, and they will provide the lending. I'm just hypothesizing as to how that may occur. But essentially, that would be the, if you like, the model of the future. Now, the banks may well have to have, as an asset, a much larger component of sovereign debt in them. That's quite possible. And as I said earlier on, maybe flippantly, that may be the solution to the future fiscal problem. So at the moment, we've got financial dominance coming through, because essentially everybody has responded to the problems in the financial sector. But in the future, these banks may be subservient to fiscal dominance because the needs of the government in selling debt are so great. Now, I'm not reading anything sinister into that. I'm just saying it's a kind of convenient solution that we may have stumbled upon.
Michael, as we reach a close, I just want to say on Twitter, people can find your work at Cross Border Cap, and your book, Capital Wars, is excellent. And I actually got the name of my podcast for guidance from the Index, hunting around for terms. Michael, if gold and Bitcoin go up in the short term, medium term, 3-6 months, and it goes up for the reasons that you are saying now, because liquidity is going up, what do you think happens to the stock market, and particularly unprofitable technology stocks, the Teslas of the world, which they did quite well in 2020 and 2021, just like Bitcoin and just like gold did for the few months of 2020?
I think if you want a roadmap, my view would be to look pretty closely at what happened in 2001, 2002. Because I think if you look at the movement of the Federal Reserve balance sheet or their liquidity injections, it's following a very similar path. Now, in my view, that's the benchmark. Now, clearly, in that period, we got the terrible events of 9/11. So we've got to strip that out. But you look at the sequencing with which asset markets moved. So it was initially what moved first were government debt markets. Then it was corporate credit markets and commodity markets. At that stage, then the economy started to get a little bit more traction. So we're talking here second half 2001, second half 2023. And then you start to see the equity markets picking up. Now, I would suggest that maybe 9/11 was a big hiccup for the equity markets and it delayed their recovery. And it may be that the tech bubble burst was a sufficient catastrophe that also took time to repair. But the equity market should respond. Now, if you believe, as take our view that what you may be looking at here is a similar roadmap, then if there is this monetary inflation created, you would expect to see gold moving upwards and cryptocurrencies moving up. And I think that is an interesting, necessary condition for the outlook that we've got. So, always look at a range of indicators. Don't just look at one or two. Look at the bigger picture here. And I think what you've got to look at is the sequencing of liquidity rising, monetary inflation hedges going up, things like commodities moving higher, credit markets performing well, and then equity starting to get traction. And if this is correct, it's going to be the cyclicals that perform first. So I'd look at cyclical areas of the US stock market. I'd look at cyclical indicators worldwide. Look at something like the DAX index in Germany, which is a very cyclical index. Or you look at things like the Korean market or maybe Japanese cyclicals because of their proximity to China. Or you look at emerging markets generally. And one of the things that was intrigued me in looking at the data that we collect is that for the first 2 months of this year, you've seen huge inflows, cross-border capital inflows into emerging markets. They've spiked higher. And that's normally, historically, a very good heads up to a turn in the global liquidity cycle. It may be different this time, who knows, but you've got all those factors. So it looks as if, the facts are telling us that we're moving in a cyclical upswing.
Thank you. Michael, we just recorded after the Fed met today on Wednesday, March 22nd. Tomorrow on March 23rd, the Grey Lady, the Bank of England, will be meeting, announcing their rate decisions. As people might tell, you're British. So I think interest rates there are at 4%. How much do you think they're hike, and do you think that they also are close toward the peak of their hiking cycle?
Yes, I believe that's right. I mean, I think there was a nasty surprise in the UK inflation data today, and I think that's a heads up for all of us to say, look, I mean, inflation is not conquered yet, but it's probably trending lower. But you will get blips. I mean, inevitably that's true. I think the Bank of England is near as well a rate peak. But I go back to what I was saying earlier on. Look, there are only really two big central banks in the world, the Federal Reserve and the People's Bank of China. And the Europeans, and including the Brits, are going to pretty much follow what the Fed's doing anyway. And China is maybe a more independent entity.
There we go. Well, you nicely put me in touch with Paul Tucker, who used to be the deputy governor of the Bank of England. So I'll be speaking with him later this week, and that interview should air on Monday. Thank you again for that, Michael. Michael Ippolito, what you got a final question?
Yeah, I actually just have one question, because everything that would just if I had to sum up, Michael, what you're saying, basically, hey, we have reached the ceiling in terms of interest rates that we can do. The part of the stress, especially you're seeing manifested in the yield curve, is a lack of liquidity in the system. So I hear those two things, and I kind of couple that with what the 2-year is doing, and to me, this seems like it should be bullish for risk assets. But again, I'm just looking at the initial market reaction here. So why aren't markets saying what the three of us are kind of saying on this particular chat here? And then my other question for you is, how does this all shake out? Because I'm with you that we do need to inject some amount of liquidity here. We don't want the banking system to fall apart. But Michael, we still got a 6 handle on inflation. Jack was just mentioning over in the UK, it's no better. So if the Federal Reserve and global central banks have their hands forced, I mean, how does this all end up playing out?
Well, let me suggest this. I mean, I'm not recommending it, but you can do it. It's there in the records. Go back and look at the FOMC testimony in 1984 in July by Chair Volcker. Okay, that came just after the bankruptcy of Continental Illinois. Okay, we know the reputation of Volcker. He was an inflation hawk. But what did he say in that meeting? He said, we have gone as far as we can go. It will be mistaken to tighten further or indicate that we're tightening further right now. Okay. And that was in the wake of Continental Illinois. So I think that the parallel is not that different. And if you looked at that, what was happening in 84 was that the Federal Reserve didn't target rates then, it was targeting money supply growth. But within a few days or weeks of that statement, US rates were down 50 basis points. Fed funds was down. So that was a very clear pointer to what happens in the rate cycle. As regards, should you buy risk assets? My view has been, I've been saying this for months now, that this year we'll see the major indexes, both stock and bonds, range bound, in my view. But this is not like 2022. You can make money this year because there'll be certain areas that will move up significantly. In 2022, everything went down. This year it's going to be very different. We're essentially at an inflection point and we're moving up. Doesn't mean to say that you can't lose money. You can lose money. Things may go down. But what I would do is to again look at the sequencing. If liquidity is turning, which we think it is, and the heads up for that would be looking at the move index, looking at the yield curve, looking at what the reverse repo is doing, the tranche in the Fed balance sheet. All those are key indicators. Look at things like the bond markets, credit markets. Look for that sequencing. Look at Bitcoin, gold. If these are all moving in the right direction, you've got a fantastic heads up that risk assets are going to be performing, because that's your base, if you like, of which risk asset markets build on.
All right, Michael, that's a great way to end it. Again, again, guys, hopefully you enjoyed this. I know Jack and I definitely learned a lot, and just want to give the big +1 to check out Michael and all the good work that he does at Cross Border Capital. So Michael, thank you so much again for coming on the show. This has been a ton of fun for Jack and I, and I'm sure our audience as well.
Great. Thanks, guys. I appreciate it.
Thank you.
Thanks so much.